So interest rates and what most property investors are getting completely wrong at the moment. So I'm going to say something that's completely crazy. Interest rates are not the reason that most investors fail, but they are definitely the reason that most investors don't progress. So what am I seeing right now in the current market? Look, I'm seeing investors sitting on the sidelines, waiting to make decisions, waiting for numbers to stack up. Investors are panicking about repayments and they're waiting for the perfect time to jump in and make their investment. And this is all because of where the current interest rates are. Let me tell you, I've been doing this for nearly 20 years. And my 20 years worth of advice should tell you one thing. And that one thing is most investors at the moment in the current market are thinking about interest rates completely wrong. And their thought is costing them the opportunities that could make them hundreds of thousands of dollars if they were prepared to take some action. Now, heaps of investors at the moment are playing the waiting game, which is, I'll just wait until rates come down and then I'll jump back in. Now, this seems perfectly logical because obviously the lower the rates get, the cheaper your holding costs get and the easier it is to hold the property. However, everyone else is doing exactly the same thing. As rates lower, your borrowing power gets better and then you can buy more property. Also, so can everyone else. So property prices increase. So therefore you have this snapshot window where capital growth happens. Now, this isn't going to pan out perfectly for anyone. If you think back to 2020 or 2021, when we had really, really low rates, what happened? Well, then the excuse for people was, oh, I can't buy anything at value because prices are going up so quickly and I think the market is a bubble and it's going to overheat. So you really want to get in very early so you have the chance to have that capital growth. Because once that capital growth happens and prices surge and the market heats up, then prices change so quickly, you'll miss your opportunity to get in and get the right property at the right price. The other one I hear investors saying at the moment is that rates are too high, I just can't get the numbers to stack up. Well, look, rates are pretty high at the moment, but the property that you're purchasing, you're not taking a fixed rate for the life of owning that property. So yes, rates are a little bit high, but have a look at what the 20-year average is on rates and have a look at the property that you're purchasing. Are we owning this property for 1 year, 2 years, 3 years, or actually hoping to own it for 10 to 20 years? If we're hoping to own it for 10 to 20 years, we don't care what the rates are today, because what we're actually looking for is what is the average rate over the life of you having that property. So stop thinking about the 12 to 24 month rate cycle that you're currently in and start thinking about what the cost of funds is going to be to you over the next 5, 10, 15 or 20 years. And once you put it in those terms, you find yourself standing in a situation whereby making a purchase now and getting the right property in a market with reduced competition makes a whole lot more sense. So let me share with you a couple of things that I've observed over the last 20 years. There's either two types of clients. There's clients that buy in a low rate environment and there's clients that buy in a high rate environment. When you're a client that's buying in a low rate environment, what you'll tend to find is you'll max yourself out and you'll be very comfortable when you actually make the purchase, and you'll give yourself a pat on the back in the first 12 months because the property price has gone up a little bit and this is what investing is meant to be like. You've also got the clients that are investing in a high rate environment. Now these clients tend to buy a better property at a lower price, but the holding costs are a whole heap higher. They also get pretty depressed at the first 12 months because of high rates, the property hasn't really gone up in value and it's cost them a whole heap of money to hold. Let's just fast forward into the future and see what happens when rates move. Now, clients that have purchased in a low interest rate environment, well, the cycle is if you buy when they're low, eventually you'll have to ride it out when they're high. Now, these are the clients that are usually, ringing me or in a panic, or they're trying to take fixed rates or refinance, get equity releases. They really do feel the pinch a little bit later on as the rates increase, which is natural and normal in the cycle that we tend to have in the Australian banking market. But the clients that purchase at the top of a rate cycle, once you get to that 3 to 5 year period, rates come down. they're actually really happy with their property. Their property over a 5-year period will tend to have a good capital growth increase, but also the holding costs get lower as rates come down. Now, these clients usually buy again in the dip, and then they are through one rate cycle where they've had high interest rates and they're prepared for it when it happens again. It actually is much more successful over a longer period to get in when times are tougher than when they're easier. Now, I think there's a real trap when you come to look for cash flow residential properties. If you think back over the last, say, 20 years, what are the properties that have really performed well for Australians and made them a lot of money? Well, they were never cash flow positive properties. They're always capital growth properties. Typically, they're in areas close to CBDs or metro centres where land is pretty scarce and good properties typically sell pretty quickly. Now, if you're always chasing capital growth and not really chasing the rental yield, then you don't care if they're negatively geared. You were always prepared to endure some hardship in order to buy that asset and hold it for the longer term to get the capital growth out of it. So getting into a situation now in a high rate period where you use the excuse of not investing because of the holding costs is a little bit redundant. You were always prepared to go through these cycles. You were always prepared to have a look at the purchase and the holding costs over a 10 to 20 year period. Whether they're a little bit high now really shouldn't matter so much, because at the end of the day, we're not chasing cash flow, we're chasing capital growth with some of these blue chip assets. Now, something that's quite popular for investors to do is consider the idea of taking a fixed rate at the top of a rate cycle. The thought being, if I fix the rate, I remove the risk. Just understand that if you do this, it's a double-edged sword. Once you've fixed the rate with a lender, understand that rates might move up. And if they do, you're not going to want to break your fixed rate, and rates might move down. And if they do, once again, for fixed rate break costs, you're not going to want to break your fixed rate. So therefore, when you do fix in this kind of rate cycle, you're really making a commitment to the lender for the term of the fixed rate. Now, that might mean your current lender maybe doesn't want to release equity against the property. They don't like your servicing calculation. They think you're maxed out already. So there is a whole heap of reasons behind that why, if you do take a fixed rate, you may actually be selling yourself short for future opportunities and whatever your future capabilities might be. So just understand that if you do think you'll fix the problem by taking a fixed rate, sometimes this can work against you a little ways down the track. So let's wrap this up and bring it all together. It doesn't matter what rate you pay so long as you consider these 5 things when you make your investment property purchase. And number 1 is buy a great asset. It doesn't matter what your rate is, if you've got a great asset in a great location that's going to appreciate in the future and make you some money. Number 2, your structure and your lender choice. Make sure, regardless of whatever you buy and whatever rate you pay, you're not putting yourself into a situation where you're kind of stuck and unable to move on to the next thing. So whenever we enter into these purchases, we want to think about how we're going to access equity against that property later on and how that could potentially help you grow and scale your portfolio. Point number 3 is make sure you've got buffers in place. If you've got a high interest rate and you've got $100,000 in the bank to help you with your holding costs of $20,000, $30,000 a year, well, you don't have much of a problem at all. So if you've got cash buffers in place that can help you ride out the highs and lows, then that is ideal and will put you in a place of great comfort. Remember, when you make a purchase, the numbers are only temporary, and your ability to borrow in the future will always improve. You'll have wage rises, your business will perform better in the future, your rental incomes will be higher in the future, so you're really entering into it at the worst possible point every time. Your situation always improves, and that unlocks future borrowing capabilities. And lastly, remember, it's a very long-term strategy when you're buying property. No one really makes a whole lot of money out of property in 12 or 18 months. They do make a lot of money out of property over 10 to 20 years. So always have a thought about building a long-term portfolio that will do the things that you need it to do. The most importantly is go up in value. So the last minute takeaways is rates go up, rates go down. Don't fear wherever the rates are at the moment. Plan for the long term and you should be just fine. If you've liked this video, please like and subscribe to our channel and feel free to share it with anyone who you think might benefit from our advice.